Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, June 6, 2025. As always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, why won't Wall Street stop fighting our near 3-year-old resilient U.S. economy theme? Our answer? We honestly have no idea, given how rock solid the hard data has been since, but our best guess is that they wish to perpetually trigger your negativity bias so that your action bias forces you to buy their brokerage, hedging, and/or research services. It's much harder to sell product as a broker-dealer or newsletter writer if the stock market grinds higher with minimal volatility. The probability of you taking money out of your account and putting it into their accounts via options premiums, transaction costs, and/or research subscriptions is low in that environment. This is likely why so many firms in our industry incessantly pump bear porn. Your negativity bias is why loud bears always sound much smarter than dispassionate bulls, and why firms that force you to overtrade your account love exposing you to myopic loss aversion, the gift that keeps on giving for perma bears across global Wall Street. This hamster wheel of fear is highly effective at making sure they retire on time and comfortably, not you. There's not much to say about the May jobs report that we haven't been communicating after nearly every jobs report since the summer of 2022. The U.S. economy remains resilient due to historically strong private sector balance sheets, expansionary monetary policy, labor hoarding, and now substantial deregulation. Each of these factors is contributing to persistent above-trend household income growth. Someday, the U.S. economy won't be resilient anymore, and you can trust that we'll be there to signal to you precisely when. Our June 2025 macro scouting report will be published this afternoon. In it, we'll provide detailed updates regarding our resilient U.S. economy, Paradigm C, J1 to soft landing, and sticky inflation themes. A ton of hard work and sleepless nights go into producing 50-slide research reports every day via our leadoff morning note, 100-slide research reports every day via our Around the Horn presentations, and 150-slide research reports every month via our macro scouting reports. But that's the amount of work that is required to remain objective, whether bullish or bearish. This objectivity helps me and thousands of you dispassionately execute our completely systematic KISS and Dr. Mo signals. Why? Because human beings tend to override systematic processes at the worst possible times, thanks to a bevy of heuristics, behavior heuristics, that trigger our emotional reptilian brain. KISS, Dr. Mo, and a deep understanding of the full distribution of probable economic outcomes is our best guess against the cognitive biases we all suffer from as investors. Transitioning to our 42 Micro dashboard, as always, we'll wrap up the question from our community. This one's titled Cooking the Inflation Books. It says, Didi, did you see this Wall Street Journal article? The Wall Street Journal titled, it says, economists raise questions about the quality of U.S. inflation data. Labor Department says staffing shortages reduced its ability to conduct its massive monthly survey. You called it first, Skipper. Have a great weekend. So thanks. Appreciate you. You have a great weekend as well. Just making sure everyone saw this Wall Street Journal article from Wednesday about the staffing shortages at the BLS and the BEA and whatnot, and how you can make the case that the data we're going to start to get out of the U.S. economy is going to become less trustworthy. I don't know, have a real, deep insight on that other than to say, data's, once they do that, obviously there's a transition period, but once they do that, the data is apples to apples. So made up numbers are relative to the previous made up numbers, do contain signal. There is signal even in Chinese made up statistics. If they're going to make it up at 4 in one quarter and then now it's 5 in the next quarter, well, they decided that growth feels better to them to make it up better. So you have to take that same mental model and apply it to U.S. statistics. And by the way, this isn't a Trump administration thing. I'm almost certain the Biden administration was cooking the inflation books as well to get inflation down. Obviously, they let in 10 plus million illegal immigrants to our country to drive down wage growth and help get inflation back under control. So, I don't, I think the key takeaway is don't let this stuff bother you as an investor. Don't let it trigger you. Don't be triggered if you're a Republican or a Democrat. Don't get overly concerned about the potential of them cooking or not cooking the inflation books or potentially pumping the GDP statistics to prove themselves right about their ability to grow their way out of this debt that they're going to add to the public sector balance sheet. Just accept it is for what it is. What it is. The best thing I learned or taught myself years ago when I first started investing, and I barely had any money back then, but it certainly helped me now. Now that I do have money to invest, investments are nothing or little more than squiggly lines on the screen that make the numbers in your account go up and down. I mean, again, let me say it again. If you treat every investment as a squiggly line that moves across your screen that makes your account go up and down, you can remove yourself from the emotion of it all and then execute it in a dispassionate investment process like Kiss and Dr. Mo that will do a much better job of helping you retire on time and comfortably than emotionally reacting to your reptilian brain about stuff like cooking the inflation books or the mendacious Republican Party lying to us about growing their way out of tax cuts. And we're going to have a lot of detailed analysis on that in our macro scouting report this afternoon. And obviously the profligate Democrat Party for putting us into this mess to begin with. So, just remember everything's just a squiggly line. You don't have to get dragged and sucked into these hot button debates. If you do get dragged and sucked into them, keep your account and how you feel about your portfolio separate when you engage in stuff like this. So that's all I'll say about that. Hopefully it's helpful. We'll catch you back here on Monday. Everyone have a great weekend. It's going to be a great weekend for 42 Macro clients. We got our macro scouting report out. It's my favorite day of the month. I love nothing more than performing deep dive research, empirical research analysis that helps our clients stay well ahead of Wall Street consensus. This is year 5 now, by the way, where we have a bunch of random retail investors, some very novice, that are dramatically outperforming many of the top funds across global Wall Street. And you want to know why? Because they're smart enough to subscribe to 42 Macro. Have a great weekend. Cheers.